this one of those weeks where you go back and revisit that call?
Well, we're revisiting in the sense that we have to incorporate the new information. What I'd say, I feel pretty comfortable that we're still in pretty good shape here. Ultimately, where we think this plays out is that we have to expect there'll be a little bit more of a earnings response on the financials as you see tightening credit conditions. We factor that into our earnings outlook to a certain degree already. I would say the risk is probably to the downside from here, but if consensus is looking for, let's call it a 14% increase in earnings for the banks this year, we're modeling closer to 2%. So we think the earnings issue here is going to play out already incorporated into our views.
Yeah, which is basically that the S&P is flat for the
ends up
in this place. Seth, what about you? Is a lot of economists changing their views and their outlooks this week on the economy and on the Fed policy path? Have you done that?
We have not. I think it's really important to try to sort out what's going to go on with the economy, with financial markets, and at this point it's hard to tell. I'll say the ECB, for example, just showed us yesterday that they were comfortable going ahead and hiking despite some turmoil on their side of the Atlantic. I think when it comes here in the U.S. for the Fed, they're going to be looking at how much stabilization have they been able to create through their new lending facility, for example, through the various deals that have gone on with some of the banks that are in trouble. And if they can come to the conclusion, as I think they will, that there is a separable situation in terms of short-term funding markets and liquidity, not a macroeconomic read-through, then I think they'll go ahead. We still got them hiking at the upcoming meeting.
And where from there, Seth? I mean, there's a lot of talk that no matter what, that perhaps the terminal rate is lower, that they'll have to convey some openness to adjusting their plans. Of course, the market pricing in big cuts already, although they've tried to over-anticipate that a few times.
Absolutely. So I think the near term and the longer term are both worth thinking about independently. So we'd still have left our rate hike for May. There are 25 basis points, but no more hikes after that. The market, before all of these financial disruptions started, the market had gone above us in terms of a peak rate, and we didn't change our call then. And now things have retraced a bit. So I think for them to hike this month, next week, and then to hike again in May, it's going to require funding markets to settle down a bit. We think chances are really good that they will. I think when they start cutting rates, though, becomes sort of an additional question. Our bank analysts think there is going to be some additional funding cost pressures for a lot of banks. To the extent that that feeds through to lending, it could lead to an earlier rate cutting cycle for the Fed as they try to calibrate the stance of policy. But that's several months off. And for now, we sort of left March of next year as a time where we think they start to nudge down the policy rate.